Should I convert my IRA to a Roth? If so, how and when? This is a big question for a lot of people because taxes are the largest expense that you will pay. Roth conversions can save you or cost you tens, if not hundreds of thousands of dollars over your lifetime in extra taxes. If we do them wrong, they're going to cost us thousands of dollars, and if we do them right, they may save us thousands of dollars. And so if you've ever heard of a Roth conversion or wondered, should I be doing this? Is this something I should be looking into? This is the podcast for you. The problem with a lot of people is that most tax preparers don't know enough about financial planning to really say whether or not you should do it. And so if you're asking your tax preparer, your CPA, your TurboTax, right, if you should do a Roth conversion, they likely don't know. Unless you were giving them your 401k statements, your IRA statements, your Social Security and pension statements, Medicare, unless you're giving them all that detail every year, they don't know enough about you to say whether or not you should do a Roth conversion. Similarly, if you ask most financial advisors or custodians, hey, should I do a Roth IRA? They're going to say, hey, go ask your tax professional. We're not licensed to give tax advice, and so you're going to need to ask them. And so you have both people, your financial advisor and your tax professional, is telling you to ask the other person if you should convert your IRA to a Roth. Not very helpful. And with the Roth conversion coming up, the deadline is December 31st to do Roth conversions here in 2022. We thought it would be a good time to explore, should you convert an IRA to a Roth? If so, how? If so, when? So this is going to be the definitive guide to Roth conversions. As part of why I think it's helpful to do this, right, is I'm a certified financial planner and an enrolled agent, which is the federal license to practice before the IRS and to give tax advice. And so there are others like us, not very many, but we kind of have that unique ability to speak to both. And so we want to go through, what is a Roth conversion? Should you do them? What are the main factors that you should consider when doing a Roth conversion? Of course, this is not investment advice. Of course, this is not tax advice, but I'm going to teach you how to think about these and the factors that you should consider. Because like with all of these things, right? Should I convert my IRA to Roth? It depends. Well, it depends on what. And that's those factors are what we're going to talk about today. So first of all, what is a Roth conversion? Well, you probably know this, but if you have a traditional IRA or traditional 401k, those are pre-tax accounts. Either you have funded those accounts with money that has not yet been taxed, right? Like an IRA, or like a 401k, if you put money into a 401k through your payroll, that money is never taxed, right? Or you can deduct what you put into it if you do like a traditional IRA contribution after the fact. And so maybe it was taxed when you earn the money, but then you put it in the IRA and you get a deduction. So either way, it's pre-tax and you haven't paid any federal or state income tax on those funds. For Roth IRAs or Roth 401ks, these are money that goes in post-tax. You've already paid taxes on this. And with both of those will grow then tax-free. But with traditional accounts, traditional IRA, traditional 401k, that money is taxed when you pull the money out, when you withdraw it. And on tax-free accounts, on post-tax accounts, Roth and Roth 401k, those monies can come out tax-free withdrawals. As long as you meet the right criteria, right, you can pull that money out completely tax-free. And so a conversion, then a Roth conversion, is when you take the IRA money that's been growing pre-tax and you decide to pay the taxes now. You transfer it from an IRA pre-tax pay the taxes on it, and you transfer it over into a Roth IRA, and then you can get that money tax-free later. Pay the taxes now, let it grow tax-free, get tax-free distributions down the road. And so that's what a Roth conversion is. And so the question is, like, are we better off paying the taxes now or later? And before we go any further, I want to just clarify a few differences between a Roth contribution and a Roth conversion, right? A Roth IRA contribution and a Roth IRA conversion. And there are three key differences between those two. The first would be deadlines. Okay, a Roth contribution, any Roth contributions are due by tax day following the year you're trying to convert it for. So if you're trying to make 2022 Roth IRA contributions where you're just putting new money into them, you have all the way up until April, I think it's 18th this year, because the 15th falls on a Saturday, and I think they allow you one extra day besides Monday to get it done. So I think it's the 18th in 2023. But you have all the way up until Tuesday then, April 18th, to contribute all the way back for 2022, right? Every year you get till the tax day of that next tax day in order to do that. With Roth conversions, though, those changes, right, moving money from an IRA to a Roth, those are due by December 31st of the year. So you have 4.5 less months to get a conversion done than you do an IRA. And a lot of people think like, oh, I can wait and figure out all my tax issues for tax day, because maybe they know about, you can contribute to an HSA up until tax day. You can contribute to a Roth IRA up until tax day. And they think conversions fall in that same category, and they don't. You have to do those by December 31st. And custodians, all these people, they're inundated with requests at the end of the year. So you don't really even have until December 31st, because they're not going to be able to process it that fast if you try to submit it on December 30th or December 31st. Really, you've got until maybe mid-December at the latest to get these done. But the technical deadline is December 31st. So you can make 2022 Roth conversions up until December 31st, 2022, right? Key distinction there. A second key factor would be in the Roth IRA limits. Roth contributions, putting new money in, you're limited to $6,000 per person per year, and you can do an extra $1,000 if you're age 50 or older, right? So $7,000 total. It's called a catch-up contribution. And you and your spouse have to have earned income in order to do that. If you're trying to make $6,000 contribution, you have to have earned $6,000 in order to make that contribution. So if you're completely retired, yes, you have income coming in, but if you're not earning any of that income, you cannot make Roth IRA contributions, right? And it's also possible to earn too much money to make a direct Roth IRA contribution. If your modified adjusted gross income is over a certain amount, you'll be phased out of your ability, and then all the way to the point where you are no longer allowed to make those contributions. You can do backdoor Roth IRA contributions, which is a separate topic for a separate day, but just know that's the case. With Roth conversions, there aren't those same limits. So first of all, you can convert as much as you want. So it's a $6,000 contribution limit, but there's an unlimited conversion amount that you can do. You can convert the entire IRA if you want to. You probably don't want to. It's not prudent, not always wise, because if you do too much, you're going to hit different tax brackets, and we'll talk about all that. But you can technically do as much as you want in a conversion. You don't need to have any earned income to do a conversion. So you must have it. You must be earning at least as much as you're trying to contribute for contributions. But if you're doing conversions, you don't have to have any earned income at all. So you can't do Roth contributions when you're retired. You can do Roth conversions when you're retired. And there's no income limits at all for Roth conversions. You can convert as much as you want, and up with no income limits at all. So there's a key difference there on the limits. We had deadlines, limits, and then the last one is on funding. So if you're making Roth contributions, putting new money in, those must be in cash. If you got other stocks or whatever sitting around in a different account, you can't just move those over. You got to sell them, move the cash in to the Roth IRA, and then you can invest again once the cash is in the Roth IRA, but you can't move a stock or an ETF or a mutual fund from a brokerage account into a Roth. You have to sell it first, put the cash in, and then reinvest it. With the conversion, of course, you can convert cash, but you can also convert funds. You can convert stocks. You can convert whatever else. So if you have, a ETF or a mutual fund in your IRA, you don't have to sell it first before you contribute it, like you do with contributions. You can just transfer it directly into the Roth, which is great because a lot of times people don't think they can do Roth conversions because the market's down right now. I don't want to sell anything and risk missing out on the market recovery and whatnot. You don't have to. You can just convert the funds just as they are. And so that's a huge benefit for planning. So we know what Roth conversions are. We know the difference between conversions and contributions, right? There's a lot more flexibility with conversions. So the question still remains, though, is should I convert my IRA to a Roth? And there are two simplistic answers, right, to this question that you'll often hear. One is always convert. And there's people that think you should always convert because Roth is the best and should always do Roth, right? And so they think, let's say you contributed $200,000 over the course of your lifetime to an account and it grew to be worth $1 million over the course of that account. And so in their minds, they're like, okay, what would you rather have? Would you rather have avoided paying taxes on $200,000 only to pay taxes on $1 million later on, which would be an IRA, right? Or would you rather pay taxes on $200,000 to get $1 million tax-free? And they look at that and they're like, well, duh, let's pay the taxes now on the lower amount and get the higher amount tax-free. That's way better. Always do Roth, always convert as much as possible, all these things. The other camp says basically to never convert. And a lot of CPAs, a lot of tax preparers are in this camp. And first, they correctly conclude that the first one is way too simple, because they say, well, look, if you had to pay taxes on this money, then you're not going to be able to contribute the same amount to a Roth as you can an IRA, right? If you had to pay money on the Roth, you can't put $200,000 into that Roth in that example because you've been paying taxes on that all the time. And since you didn't put $200,000 into it, it's not going to be worth $1 million. And so, yeah, right, maybe you've got $1 million in your IRA, but you paid all these taxes on your contributions to go into the Roth, so now that's only worth $750,000, right? Or consequently, maybe if in your example, like, well, we're going to pay those taxes out of a different account. They're still going to come back and say, well, what if you had just not paid those taxes, done a traditional IRA instead, and then taken all those tax savings from that other account you were planning to pay the taxes on and put those in the IRA as well, or some other account. And so therefore you might have that $1 million in a Roth because you were going to pay the taxes from elsewhere, but you could have a lot more than $1 million in an IRA if you chose to do it pre-tax instead. And they're right about that math, right? But what they look at then is they say, hey, should we avoid taxes on $1 million or on $200,000 and have $1 million in an IRA down the road, or should we pay taxes on a Roth IRA and potentially have $750,000 down the road? And they tend to kind of look at it as just like a net worth and say, well, if you're going to limit your growth, if we have to pay taxes now, you can grow more and have more net worth, have more in your investment, more in your retirement accounts if we do pre-tax. And so I know I've seen a lot of tax preparers and CPAs just recommend the IRA always over a Roth, and to not recommend conversions because they just look at the net worth number. Both of these answers are incorrect. Okay, because the question becomes, and they're correct in their math, right? Like you might end up having $1 million in an IRA or $750,000 in a Roth, and so the question is, well, what's better to have? But the answer to always convert or the answer to never convert, both are wrong, and so it always depends, and it depends on what your taxes at withdrawals are going to be. So there's actually 3 factors that dictate whether or not you should convert your IRA to a Roth. The first factor is, what are tax rates at conversion and withdrawal? Right? What are the tax rates going to be at conversion and withdrawal? Because there's 2 options for paying tax. Right now, you can pay now at conversion, or you can pay later at withdrawal. And so the tax rates now and later are the main determinant for whether or not you should do a Roth conversion, right? The tax rates now and later are the main determinant for whether or not you should do a Roth conversion. So let's say, for simple math, right? Let's say that you have $1,000 in an IRA and you're wondering if you should convert it. And in this example, the tax rates are 25% now, and we believe they're going to be 25% down the road. Should we convert? Well, let's take a look. If you go to the blog post for this podcast or this video, it's retirementorship.com/87, because this is the 87th episode. You can see this table, and there'll be a bunch of other links in there that we'll reference down the road. And so it might be a good idea to check out the blog for this. Again, retirementorship.com/87. That'll get you to it. So you'll be able to see this table. I'll walk us through it. So you have an initial amount, $1,000 each. Are you going to leave it in an IRA, or are you going to convert it to a Roth? Well, if you have to pay taxes now, you're going to pay nothing right now in an IRA, right? Because you avoid taxes as pre-tax. You're going to pay 25% in the Roth IRA. And so 25% of $1,000 is $250. And so at the end of that, the amount you have left over now to grow is you have $1,000 in the IRA and $750 in the Roth. That's how much you have left to grow. Then you leave it in there for some amount of time and it grows, and let's say they both double, right? And so $1,000 then doubles to $2,000, and $750 though, this is where the CPA points out, right? That's only going to double to $1,500. And so right, at the end, you're going to have more in your IRA than in your Roth. But do you really have more if it hasn't been taxed yet, right? So now when you pull it out, you're going to have to pay taxes. And so in your Roth, you need to pull out that $1,500. Do you owe any taxes on it? No, you don't. So when you pull $1,500 out, you get $1,500. When you pull the $2,000 out of the IRA, do you pay taxes on it? Yes, you do. And if tax rates are still 25%, you pay 25% of $2,000, which is $500, which means that you pull out $1,500. Roth IRA $1,500, traditional IRA $1,500. It's the same? Yes, it is. And that's the main point, right? If tax rates are the same at conversion and at withdrawal, or at contribution withdrawal for that matter, then it doesn't matter. It makes no difference if you convert or not, if you do Roth IRA or traditional, if tax rates are the same now and are later. Of course, it assumes you invest them identically, if the growth rate's the same and all that. But everything else being held equal, it doesn't matter. So the only thing that matters are, what are your tax rates going to be? And we know what they are now, right? Because they are whatever they are, right? We know what 2022 tax rates are. And if you're watching this in the future, maybe they've changed, but we know what they are in this moment when we're making the conversion decision. The question is really, what are they going to be at withdrawal? And there are two things that can affect your tax rates at withdrawals. One is your spending and earnings may put you in a different tax bracket. Right? Your earnings and spending may put you in a different tax bracket. Some people are earning a lot now while they're working, and so they're in a high tax bracket while they're at the tail end of their career. But they're planning to spend less in retirement, and so they believe that they'll be in a lower tax bracket when they're retired and when they actually start using this money. Other people are the opposite. Right? They are earning a certain amount now and really saving, really chugging away, but they actually plan to spend more in retirement. They want to, get a second house, or they want to, go on lots of vacations or whatever else. And so they actually think, hey, we might actually be in a higher tax bracket in retirement than we are now. And so how much you're earning when you're earning and how much you're spending in retirement, and therefore how much you need to take out, that's going to put you in a different tax bracket, right? So your brackets change based on like how much income you have, and those rates can also change as well, right? So the more money you earn, the different brackets you're going to end up in, and they can change though the rate at each bracket whenever they want. And that's the second thing that can change, right? Is that Congress may change the tax rates, and they can do that anytime they have enough votes. So if they want to make it up, move it up, down, sideways, wherever else, as soon as they have enough votes in Congress to change it, they can change it at any time. And so a lot of times the best we can do is kind of assume that they might be similar to what they are now, but we're not going to know. But I think one thing to think about, right, is that the taxes are the lowest they've ever been right now in 2022. And, the government has given away trillions of dollars in COVID stimulus. They just declared, although it's not been yet processed as a recording, student loan forgiveness. And so they're giving out lots of money. And so do we think that in the future that taxes are going to be lower than they are now? Or higher, or the same? It's hard to imagine that they'd be lower, right? They might be the same, but it's hard to imagine they'd go lower, and it's pretty easy to imagine that they would go higher. And so those are two things that will affect how much taxes you might pay in the future. And so to Roth or to not to Roth, right? Which should we do? How do we decide based on those tax rates? Well, if tax rates are going to be higher at withdrawal, then you should convert, right? Let's pay the lower taxes now so that we avoid paying the higher taxes later in retirement. If tax rates are going to be lower at withdrawal, then we should not convert, right? Why would we pay the higher taxes now only to avoid lower taxes in the future? We don't want to do that. That would be stupid. So if we think that they're going to be lower in retirement, either because we're going to be in a lower tax bracket or we think that tax rates are going to go down, we wouldn't convert, right? We would not convert. We do traditional contributions, and we would not do any Roth conversions. If tax brackets are going to be the same, all right, especially if the brackets are going to be the same, especially like if you think like you're making a certain amount now and you're kind of in the middle of, maybe you're in the middle of the 12% tax bracket, or in the middle of the 22 or the 24% tax bracket now, and you're like, in retirement, we're basically going to spend the same. We don't think we're going to go up and down in a tax bracket. That's going to be the same. And so you think, it's going to be the same in withdrawal as it is now, then you should still consider converting, right? Because even though you might end up in the same tax bracket, your tax rates are still, I think, more likely to go up in the future than they are to go down. And if they stay the same, there's no difference, right? We saw that already. So if you decide to convert now and then you end up in the same tax bracket later and it's the same tax rates, you didn't lose anything. It's exactly the same. But if rates go up, then you've won. Rates would have to go down for you to lose in that scenario. And that doesn't seem very likely that you have lower taxes than we do now at the lowest point ever. And so if you think that tax rates in the future are going to be up, or you're going to be in a higher tax bracket, or you think it might even be the same, then you should really consider doing a Roth conversion. And only if you think that you're going to be higher in retirement would you refrain from doing that. But there are two more considerations that we should look at before we decide whether or not we convert. One being the dreaded tax bomb. And so that's what we're going to talk about next. Factor number 2 is, what are your RMD estimates? So money in your IRA has not been taxed, right? It's never been taxed. And after a while, the government says, hey, you've been avoiding taxes on all this money for all this time, and we want our taxes. Show me the money, right? We want you. So at age 72, they're going to force you to start taking money out of your IRA so that you have to pay those taxes. And those are called required minimum distributions. You can always take more out of your IRA than that, but you cannot take less. And if you try to avoid taking the RMDs, there's like a 50% excise tax on that. So you have to take them out. And if you have enough money in your IRA, or you will by the time you hit 72, right? For a lot of people, and again, we underestimate the compounding effect. We're like, hey, we're only 50 now. Like, doesn't look like it's going to be a big problem, but we're not going to have that much more at 72. Yes, you will. And so if you're going to have enough at 72, these RMDs can be far more than you want or needed to pull out of your IRAs, and they can spike you into a different tax bracket. And so maybe your planned spending is going to have you in a same or lower tax bracket, but then your RMDs will spike you into a new one, and if that happens in the first year, you're probably doing that every single year. And so now you're paying tens or hundreds of thousands of dollars more over your lifetime from 72 on because we had too much money in our IRAs, and that's a tax bomb, right? It's just going to be tons of extra taxes that you have to pay, and we'll pay the taxes we need, but let's not leave them that kind of tip. Right, so right now, tens of thousands of households are going to end up being forced to pay more taxes than they otherwise need to over their lifetime because they're not planning correctly. And so, that's where this tax planning comes in. That's where Roth conversions may come in to help with that. And so we need to look at what are our RMDs, what are required minimum distributions likely to be. And so what's the solution for that? Well, first let's look at the third factor, right? And the third factor is, what is the tax impact on Social Security and Medicare for doing Roth conversions? If your taxable income is low enough, your Social Security benefits will be completely tax-free, which is great. But if your total, and it doesn't have to be your total income, doesn't have to be low enough, just what's called your provisional income, a certain way they calculate that. And Roth withdrawals don't count towards that income. So you can always pull money out of a Roth IRA without moving that. And so if you can keep your provisional income low enough, your Social Security benefits are completely tax-free. But if it's too high, then up to 85% of your Social Security benefits could be taxed. And you think about it, right? You've already been paying Social Security tax your whole life, and now the benefits might be taxed as well. And so we need to look on the effect of Social Security. Similarly, if your taxable income is too high, you may pay additional Medicare premiums on both Part B and Part D. Right, and so if you paid Medicare taxes your whole life, you still have to pay Medicare premiums. Everyone does for B and D and a C if you do that. But in this case, you may also have to pay additional premiums if your income is too high in retirement. So the taxability of Social Security and the extra taxation of Medicare should both be considered when we're looking at, should we do Roth conversions. So how do we reduce all these taxes in retirement? Well, we lack the time now. I'm trying to keep this short-ish, and it's harder to explain some of these things just via audio without some visuals. And so we lack the time now to really dig into factors 2 and 3. And it's hard to communicate these things just verbally. So if you want to know more about this, we're going to do a workshop on reducing taxes in retirement, right? Which is basically over the rest of your lifetime. Reducing taxes in retirement. So we run a workshop on the third Thursday of every month. And so this coming Thursday, just 2 weeks from when this comes out, on November 17th, we'll be doing a workshop on reducing taxes in retirement. And with that, then we'll have some more visuals, some tables, some illustrations, things that make it easier to understand. And anyone can attend. It's free. You can register. You can go to retirementmentor.com/workshops. There's links in the description of both the podcast and the YouTube video here. You can go to the workshop page and register for that. And if you're a retired member, which again is part of our free membership community, you can also get a workbook to go along with the workshop, which helps you follow along, helps you take better notes, helps you really understand better what we're talking about. Taxes are obviously a complex topic. We're going to try to make this as easy to understand as possible and give you some really good notes to take home and potentially save you tens, if not hundreds of thousands of dollars over your lifetime. And so we talked mostly just about the brackets today. There's some other things to consider. We'll talk about all of that plus more ways to save on lifetime taxes in that Reducing Taxes in Retirement workshop. So make sure you register for that, and we'll get all of those questions answered, or at least give you, again, the framework for how to answer them for yourself. So how do should we convert? And maybe you can do some dirty math anyways, and you say, hey, maybe it makes sense. Tax rates are either going to be the same or they're probably going to be higher in retirement, so we should convert now. So how do I convert my IRA to a Roth? And your financial advisor or custodian, such as Schwab or Vanguard, they can help you with this, right? Conversions are direct transfer from one account to another, from your IRA to your Roth. They transfer electronically, and so you need to go issue this through your financial advisor or through your custodian, wherever your money is being held. You will owe taxes on the conversion, though, right? Again, we're paying the taxes now in the IRA so that it can grow tax-free for retirement. And if you live in an income tax state, then you can pay state income taxes as well. And so if you convert cash, then the tax liability is easy to calculate, right? If you're in the 22% tax bracket for federal, and like in Wisconsin, this probably puts you in the 5.3% for state. You convert $10,000 in cash, you just multiply that by 22% for federal, 5.3% for state. There's your tax liability, right? That's what you owe. And if you convert funds, right? If you don't want to sell mutual funds or ETFs inside your IRA, and so you just convert them straight to your Roth without having to sell them first and then reinvest them. The moment it executes, your custodian will give you hey, here's the number of shares that we converted and the exact price that they were converted at, right? Most conversions happen instantly. But it'll give you that record, and then you can do the math on that and find out, okay, so then this was the total value. It's harder to dial that in because it changes by the minute or by the second sometimes even. But you'll still be able to calculate it after it's been completed. So you'll know how much taxes we owe. So how do we pay those taxes on the conversions? Well, you've got two options for paying taxes on conversions. One, you can withhold the taxes. Right, and so when they send the money over, your custodian will just withhold the taxes and pay them to the IRS and the state on your behalf. And this can be handy if you're over age 59 and a half, because then you don't have to have any other extra money, and you're going to pay the taxes out of that account anyways when you pull it out later, and so you can just convert it now and withhold the taxes, and you're good to go. But, and this is important, if you withhold taxes and you are under age 59 and a half, those taxes are considered a withdrawal, not a conversion. Because it didn't actually make it into the Roth IRA because it came out to pay taxes. That is a withdrawal and not a conversion. And thus, those will be subject to the 10% early withdrawal penalty. Right? And so you think about it, right? It's a big deal because a lot of people get this wrong. A lot of investors get this wrong, and a lot of amateur professionals get this wrong too. They just don't realize, they're like, oh yeah, we'll just do a conversion, and like they don't care about tax brackets. And I've heard of advisors or from tax professionals of advisors that will just they'll find out after the fact that their advisor recommended this big conversion. It put them in a new tax bracket. They withheld the taxes from the conversion, which generated a whole bunch of penalties, and it's this whole nightmare. Because you think about it, if you're paying a 10% penalty, then on those taxes you withheld, then you need to pay, you're pulling those out to pay that penalty. But then you owe a 10% penalty on the amount you pulled out, and so you have to pay a 10% penalty on that, and so on. So for example, if you withhold $1,000 in taxes, there's a 10% penalty on that, or $100. So then you need to withhold $100 more to pay for that penalty, which means that you pay a 10% penalty on that $100. And then you pay a 10% penalty on the $10. And at the end of the day, it's not just a 10% penalty. You end up paying $1,111 in taxes instead of just $1,000. And it's a much bigger deal, obviously, right, on bigger conversions at higher tax brackets. So if you are under age 59 and a half, you'll most likely want to use option 2. Option 1 is withhold them. Option 2 is to pay your taxes from a non-retirement account. And so you can simply pay your calculated taxes on the conversion from cash you have in your bank or a brokerage account, right? And you can submit those taxes online. That's the way I always recommend to do it for federal taxes and for most, if not all, state taxes as well. taxes on a conversion are generally due at the tax filing deadline for the year of the conversion. So if you convert in 2022, you have until April of 23 to pay those taxes generally. But here's the caveat, right? You may be subject to an underpayment penalty if you owe too much at tax day, and because if you did Roth conversions, right? So I always recommend that you pay your Roth IRA conversion taxes either right away when you do it or according to the self-employment to estimated tax due dates, right? And there's other ways to avoid those underpayment penalties, but a lot of times those are hard to hit or hard to make sure that you're doing right, hard to calculate. And so I always think it's just better to just get it out of the way, pay it either right away when you do it or do it by the estimated tax deadlines. There's a link in the blog post, again, retirementship.com/87. Will take you to the blog post, and there's a link in there where you can find your estimated tax due dates and the link to pay for them. If you do it now, up until December 31st, you have until January 15th to pay those. So you can find all that. So if you do it, you can withhold if you're over 59.5. I would really recommend paying with outside money if you're doing it underneath, and you're younger than 59.5. And so the last question then, before we wrap this up, is when should I convert my IRA to a Roth, right? We saw should we, how do we, and when should we? So, right, a potentially great time to convert is when equities are temporarily down, right? Because you can pay a lower tax bill and on the same converted number of shares, and when the value recovers, all that growth will be tax-free, right? You hadn't paid any taxes on it, the account value goes down, you convert it here, you pay less tax because the value's down, and then when it grows back, it's all tax-free growth, right? And we talked about this in episode 67, which is bear markets aren't bad, and you can go back and find that or go to retirementship.com/67 to find that episode. But if the market is down, for example, 20%, there's going to be a 25% recovery to get back to that, right? And it's the farther it goes down, the more the subsequent recovery becomes. So that means if you do it when the market's 20% down, that means you may be able to pay 20% less in taxes and then enjoy a 25% tax-free gain on that when that market recovers. And it's going to be even more if you do the conversion when the market's even lower, right? So technically, you won't benefit from bear market conversions if you're withholding taxes and you're in the same tax bracket. Like just in the same way that it doesn't matter if you convert or not, if you end up in the same tax bracket. Same is true with this. It's counterintuitive, but it's true. But this works really great if you're paying the money from outside tax accounts, right? From outside accounts, or you are trying to max out a lower tax bracket. And then you're able to get more shares down underneath inside that tax bracket than you would otherwise be able to do. So now, if you're listening to this and the market's still down, now might just be an excellent time to convert. We've done a ton of Roth conversions this year. In my practice, we did a bunch back in June when it kind of had bottomed out, and then it was going back up, and it come back down, and we've been doing a bunch more this fall. And so it's a great time. Again, can't give you specific advice, but in general, when the stock market's down, it's a great time to do it. Because again, you don't have to sell it. You can leave all those funds invested and convert the shares directly over. You don't have to sell and then rebuy. You can go straight over into your Roth without ever having to sell. If you're like, man, this is a lot. There's a lot of things there, and there are a lot of things. And we haven't even talked about some of the other, things about there's additional things on, if you do Roth conversions, there's the 5-year rule where you can't pull it back out. All these different things that we haven't even gotten into. There's lots of rules around this. And so you might be thinking like, man, how do I get help with this? Well, a couple things, right? First, register for the workshop in 2 weeks on reducing tax and retirement. That'll give you a lot more ideas, a lot more answers for questions. But it's a complicated subject. And like we said at the beginning, right? Most professionals either lack the training or the licensure to be able to talk about this, right? Tax preparers, they just don't know enough about financial planning or your situation to give good advice. And unless you're submitting all your stuff to them, they just don't know. And it's not that, again, I'm not digging on CPAs or tax preparers at all. Most of them, if you were giving them all your information, a lot of CPAs, if you're giving them all your information and you were paying them for additional consulting time, they could actually give you good advice on whether or not you should do one. But that's not how most relationships are, right? You see them once a year and they do your taxes and you say, peace out. So it's not a knock against a lot of their training. that's just not the relationship you have with them, right? And so if you just ask them, like, hey, we're doing a tax, like, hey, should we do a Roth IRA? Or you just call them up and they're like, I don't know, I haven't even looked at your account since we did it, last year. They're just not equipped. That's not the relationship that they have with you. And then most financial advisors aren't licensed to give tax advice. And so if you ask them, they'll say, hey, go ask your tax professional. I can't give them. In most cases, their firm makes them say this because their firm knows, hey, the advisor's not licensed to give tax advice. We don't want to get any hot water with the IRS for giving misleading or wrong advice. So just don't touch it. Just don't touch it. We can't give tax advice at all. And sometimes, you'll even have investment advisors who will recommend against Roth IRAs because they get paid as a percentage of your assets. And so if you do some big Roth conversions and you pay a bunch of taxes, it's going to bring down your total assets and then they get paid less. And so if they're not a true fiduciary, right, there's nothing wrong with being paid that way. But if you're a true fiduciary, if you're working in the best interest of the client, that won't matter. That shouldn't factor into that conversation. But for some people, it does. And so they'll be hesitant to recommend Roth conversions or go along with them because it means that they'll be paid less. And so that's why, again, the importance of working with a true fiduciary. And so you may be able to get your tax advisor and your financial professional to work together, but that can be difficult. And so one of the other solutions then is to work with a duly licensed financial and tax planner. Right? And so if you want advice and execution from just one person, you can find some fiduciary certified financial planners that are also licensed to give tax advice, or maybe they have an in-house CPA or an in-house tax preparer, and so it allows them to do both. So for example, right, I'm a certified financial planner and an enrolled agent, which is the federal license to give tax advice and practice before the IRS. So every financial decision has these big tax implications. So I'm surprised that there aren't more of us than there are, but you can find us. And of course, you can always reach out to us at laxfp.com. Links in the description below if you want some help with this. But time is running out, right? We only have until December 31st of this year to do these. And realistically, you only have until about mid-December to actually get the request in to do a Roth conversion. Maybe December 10th, something like that. So, converting your IRA to a Roth IRA could potentially save you or cost you tens of thousands of dollars in taxes. And so this is a really important decision, and we're running out of time to capitalize on this opportunity if you could save. So, you must calculate, or you must get your financial planner to calculate whether this is right for you, and then you got to act on it, right? Then we got to do it. And so there's a lot to it. We're here to help. Find someone else who's willing to help. And we look forward to saving you a bunch of taxes. We'll see you hopefully at the workshop. Register, retirementship.com/workshops. And I look forward to seeing you there. If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, where you can click on the link in the description and it'll go right there. We can't wait to see you in the community. Cheers. This podcast is educational only and is not investment, tax, or legal advice.